Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing podcast. CMQ investors, welcome to the show. It's great to have you here.
Great to be here.
Throughout his life and on his journey to becoming the greatest investor of all time, Warren Buffett did something that we'll be doing in this episode. We're going to study one of the financial disasters of the past, specifically the dot-com bubble and when it burst. I recently came across an article that was published by CNN Money in November of 2000 that allowed me to appreciate just how crazy the dot-com bubble was and how terrible the aftermath when the bubble burst, just how terrible that was.
I lost my kids.
In this episode, you will learn the most valuable lessons from that time that really I have found to be incredibly useful right now in 2021. I'm not saying that we're in a bubble. I'm not saying that you should, freak out. And meanwhile, at a CMQ investing listening party, I'm not saying that we're in a bubble. I'm not saying
It's
that
a bubble. It's a bubble. We're in a bubble.
But just by learning about this crazy time, it's allowed me to be more rational in these times. If you're excited about what's to come, please follow us on Apple Podcasts, subscribe on Spotify, leave us a 5-star rating, write a review. It would mean a lot and it goes a long way. With that said, let's dive right in. It's hard to think of a publicly traded internet company that is not down at least 75% from its 52-week high, and that hasn't trimmed its expenses or laid off workers. While industry groups have always drifted in and out of favor on Wall Street, it's rare to see an industry evaporate as quickly and completely as web stocks did. Some of the largest losses on a dollar value basis came from networking equipment giant Cisco Systems, which has lost $210 billion in market value from its peak. The internet incubators CMGI and Internet Capital Group have lost a combined $100 billion from their apex. The web portal Yahoo, which shed $102 billion, and America Online, which is worth $92 billion less than at its highest point. I want to jump in really quickly because they didn't phrase this next part that well, but there were 280 stocks that were part of this Bloomberg Internet Index. More than half of those stocks were down at least 80% from their 52-week high, and actually 79 of those stocks were down 90% or more, as I said, from their 52-week high. That's brutal. The collapse of the internet bubble, perhaps one of the largest financial fiascos in U.S. history, came after a 3-year period starting in January 1997, when investors would buy almost anything even vaguely associated with the internet, regardless of valuation. Investors ignored huge current losses and were willing to pay 100 times expected earnings in fiscal 2002. They were goaded by bullish reports from sell-side securities analysts and market forecasts from IT research firms, such as IDC, Gartner, and Forrester Research. The venture business is all about excess and then correction, said Steve Bankston, a managing director at PricewaterhouseCoopers. It's like disk drives in the 1980s, when venture capitalists funded 50 disk drive makers when the world needed 3. I mean, wow. It reminds me so much of what we were getting to in our episode about thematic ETFs being a ripoff for retail investors. Stocks that skyrocketed north in a fashion never seen before will plummet south in a fashion never seen before either, Bankston added. A lot of companies that don't have path to profitability or a leading position in their market will be shut down rather than receiving second or third rounds of funding. When public markets became glutted with new, money-losing web companies in 1999, that picture changed rapidly. Venture funds are very reluctant to sink more money into struggling, privately held web companies that would be difficult to take public. All of us in the venture capital area are going through a triage where we have to decide which portfolio companies are so wounded we will never save them, Wilson said. As horrible as it is to go through that process, it's a cleansing process. To have some branches grow and bear fruit, you have to trim others.
They say to trim it. No, not my foot. Sit still.
Most industry sector booms, such as the biotech bubble of 1991, feature a large volume of IPOs in the hot sector, with the highest quality companies being the first to go public and the quality of offerings degrading as the boom reaches its later stages. The internet bubble was no exception to that trend. Yahoo, considered to be one of the highest quality, most blue chip internet stocks, went public in April 1996, becoming one of the first to trade in public markets. Amazon.com, the giant of web retailing, went public in May 1997, still early in the cycle. According to the New York-based securities data firm ComScan, web companies raised a total of $1 billion in 34 IPOs in 1997, rising to $2 billion in 45 deals in 1998, and then exploding to $24.1 billion and 292 IPOs in 1999. The collapse of the dot-com bubble has resulted in bad news about layoffs or losses being issued almost every day. On November 7th, for example, Pets.com, an online pet supply retailer that had spent millions promoting its brand, decided to shut its doors and laid off roughly 255 of its 320 employees.
You're fired. Clean out your desk, losers.
The high rates of consolidation and failure that web companies are going through now is typical of many newly emerging industries throughout American economic history. Again, that thematic ETF episode, this goes hand in hand. Whenever a new technology comes along that is oh my God, Kathy, look out, Kathy Wood. Whenever a new technology comes along that has the potential to dramatically change the competitive landscape, hundreds of companies are formed to try to exploit that opportunity, including many with weak management or poorly thought out business plans. Intense competition ensues, returns on capital fall, and most of the new entrants either merge or go bankrupt. The consolidation of the U.S. railroad industry in the 20th century shows this pattern. In 1929, there were 163 Class I railroads in the United States. Today, there are 7 Class I railroads remaining, and they carry more than 90% of the rail freight in the United States. Merrill Lynch analyst Henry Blodgett, one of the leading bulls on web stocks, warned about a shakeout in the internet industry in a 330-page report issued last June. Wonder if it really took 333 pages. He's like, I just wrote a nonfiction. Yeah, tell us about it. No, it just says that the market's going to crash. Oh, okay. There were about 300 public business-to-consumer web companies trading last June, only 5 of which were profitable at the time. Blodgett believes that in 3 years, only 15 to 20 will be profitable. Okay, now this gets interesting because it was about how fast this all happened. While high rates of consolidation and failure among web stocks aren't at all surprising, the speed and severity of those failures has caught some investors off guard. Businesses that launched and operated at internet speed have failed at internet speed. For example, the name your own price web discounter, Priceline.com, went from $94 per share to less than $4 per share within the space of 8 months. PaineWebber began coverage of Priceline last January with a buy rating and a 12-month price target of $95, saying that Priceline, and I quote, is truly revolutionizing commerce as we know it, providing a way for sellers to dispose of unwanted product while maintaining the integrity of their existing price structures, end quote. Quick note on that. Notice how they mention nothing about the business. 8 months after that research note was issued, Priceline announced plans to close its gasoline and groceries operations, called Webhouse Club, after they burned through most of the $360 million they raised over the past 2 years. The grocery industry proved to be reluctant to eat the cost of discounts offered by Webhouse, forcing the new venture to subsidize the cost of its customers' groceries. Ironically, Priceline's revenue in the quarter ended September 30th was 18% higher than PaineWebber had forecast it would be, and its operating loss was smaller than forecast. What had changed was investors' perceptions about the future growth of the company and the popularity of the name-your-own-price business model. Web-based retailers and websites supported by advertising revenue have proven to be the 2 most failure-prone types of internet business, and there are lessons to be learned from each segment. Web retailers underestimated how much infrastructure they would have to build and how much logistics work they would need to do to duplicate traditional brick-and-mortar retailers. In some cases, web retailers have found that customer acquisition costs were much higher than they anticipated. And, to make matters worse, traditional retailers have launched their own web operations and proven to be formidable competitors. The legacy retailers are really waking up and going after the net big time, so the competitive landscape has changed for the pure .com companies, said PricewaterhouseCoopers Bankston. Huge venture funds have been formed to help traditional companies create web operations. Finally, businesses that are narrow margin in the brick-and-mortar world, such as books and consumer electronics, have proven to be narrow margin on the web too. Amazon had about $638 million in revenue in the quarter ended September 30th. After deducting its cost of goods sold, marketing and selling expense, and general and administrative expense, only about $3 million is left over. With the exception of about 15 major web destinations, websites supported by advertising are fighting for their lives, and in many cases, losing. It goes on to say that most of the advertising dollars are going to a few large sites, leaving thousands of smaller sites to starve. Now, during the creation of this episode, so pretty much just in the last couple of days, I was also reading a book, and still am reading a book, called A Random Walk Down Wall Street. And there is a section about the various bubbles that have happened in the stock market over the years, and I read something about the dot-com bubble that, well, it just belongs in this episode. So I want to read that to you now. Also, just a reminder, if you haven't already, it's very easy to forget. Follow on Apple Podcasts, subscribe on Spotify, make sure to leave a review, leave a rating. It goes a long way. And I have a surprise for you after we get through this next passage that, well, hopefully it'll ensure that we earn it. Now, what I'm about to read to you comes from A Random Walk Down Wall Street. Fraud aside, we should have known better. We should have known that investments in transforming technologies have often proved unrewarding for investors. In the 1850s, the railroad was widely expected to greatly increase the efficiency of communications and commerce. It certainly did so, but it did not justify the prices of railroad stocks, which rose to enormous speculative heights before collapsing in August 1857. A century later, airlines and television manufacturers transformed our country, but most of the early investors lost their shirts. The key to investing is not how much an industry will affect society, or even how much it will grow, but rather its ability to make and sustain profits. And history tells us that eventually, all excessively exuberant markets succumb to the laws of gravity. The consistent losers in the market, from my personal experience, are those who are unable to resist being swept up in some kind of tulip bulb craze. It is not hard to make money in the market. As we shall see, an investor who simply buys and holds a broad-based portfolio of stocks can make reasonably generous long-run returns. What is hard to avoid is the alluring temptation to throw your money away on short, get-rich-quick speculative binges. There were many villains in this mortality tale, but it was the infectious greed of individual investors and their susceptibility to get-rich-quick schemes that allowed the bubble to expand. And yet the melody lingers on. I have a friend who built a modest investment stake into a small fortune with a diversified portfolio of bonds, real estate funds, and stock funds that owned a broad selection of blue-chip companies. But he was restless. At cocktail parties, he kept running into people boasting about this internet stock that tripled or that telecom chip maker that doubled.
I'm so rich.
He wanted some of the action. Along came a stock called Boo.com, an internet retailer that planned to sell, with no discounts, urban chic clothing that was so cool it wasn't even cool yet. In other words, Boo.com was going to sell at full price clothes that people were not yet wearing. But my friend had seen the cover of Time with the headline, "Kiss Your Mall Goodbye. Online shopping is faster, cheaper, and better." The prestigious firm of J.P. Morgan had invested millions in the company, and Fortune called it one of the cool companies of 1999. My friend was hooked. This Boo.com story will have all the tape watchers drooling with excitement and conjuring up visions of castles in the air. Any delay in buying would be self-defeating. That's apparently a quote from the friend. And so my friend had to rush in before greater fools would tread. The company blew through $135 million in 2 years before going bankrupt. The co-founder, answering charges that her firm spent too extravagantly, explained, "I only flew Concorde 3 times, and they were all special offers." Of course, my friend had bought in just at the height of the bubble, and he lost his entire investment when the firm declared bankruptcy. The ability to avoid such horrendous mistakes is probably the most important factor in preserving one's capital and allowing it to grow. The lesson is so obvious, and yet so easy to ignore. Even just reading those last few sentences, I'm immediately reminded of a number of Charlie Munger quotes. The first quote I think about is, "A lot of success in life and in business comes from knowing what you really want to avoid." Another quote from Charlie goes like this, "There's a whole lot of things that aren't going to work for you. Figure out what they are and avoid them like the plague." The reason you want to avoid those terrible mistakes, like the author's friend who invested in Boo.com, Well, as long-term investors, those mistakes interrupt the compounding process. This quote comes from Charlie Munger. The first rule of compounding, never interrupt it unnecessarily. Charlie Munger also says, the elementary mathematics of compound interest is one of the most important models there is on earth. And that's why our podcast, in part, is called Compound Money Quietly. That's what it's all about. It's a big idea that really works. You know, what's really interesting to me is how this all kind of comes full circle with the surprise ending. It comes from Jeff Bezos' letter to Amazon shareholders to recap the year 2000. I just want to read you two portions here because what Jeff Bezos says in this second portion is exactly what I was thinking. Now, obviously, that means I'm Jeff Bezos, and it's only a matter of time before I'm in a phallic object headed directly to space wearing a cowboy hat. But all jokes aside, let's get into this. To our shareholders, ouch. It's been a brutal year for many in the capital markets, and certainly for Amazon.com shareholders. As of this writing, our shares are down more than 80% from when I wrote you last year. Nevertheless, by almost any measure, Amazon.com, the company, is in a stronger position now than at any time in its past. So, if the company is better positioned today than it was a year ago, why is the stock price so much lower than it was a year ago? As the famed investor Benjamin Graham said, and I quote, "In the short term, the stock market is a voting machine. In the long term, it's a weighing machine." Clearly, there was a lot of voting going on in the boom year of 1999, and much less weighing. We're a company that wants to be weighed, and over time, we will be. Over the long term, all companies are. In the meantime, we have our heads down working to build a heavier and heavier company. But that's the lesson. Everything has to come back to reality. If you're not sure what we mean about that, I don't want to overwhelm those of you who've been listening, to every episode up to this point. But if you go back from episode 1 and listen all the way through, what I just said will make all the sense in the world. Sure, there are times when investors can make a lot of quick money speculating, but you never know when things will go from being a voting machine to a weighing machine. And when that happens, if you're not holding on to anything substantive, well, you're going to be left holding the bag. This has been Compound Money Quietly, the CMQ Investing podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.